Welcome to The Explainer. Today, we're stepping back into our documentary series, GoldMining Europa, specifically episode 07. We are completely setting aside all that typical trading hype to track the unvarnished mathematical reality of a real RoboForex cent account. We're pursuing an ultimate target of 10,000 cents, trading exclusively on the EURUSD pair. We'll be keeping things calm and analytical today as we really unpack the process of progression. So, let's dive right in. Right, so starting off with the week 25 operational dashboard, we can really anchor down on our core metrics for the week. For this reporting period, the account secured a very modest 0.63% weekly gain. That translates precisely to 16.20 cents in profit. Now, I know that might seem like a pretty small step, but remember, the entire objective of this series is consistent, long-term progression, not aggressive, high-risk overnight returns. Exactly. So our roadmap for today's briefing is pretty straightforward. We're going to start by setting the scene with a market overview for week 25 and analyzing the EURUSD macro environment. From there, we'll look under the hood at the specific weekly trading activity, have a very transparent conversation about navigating the drawdown, and then zoom out to look at our long-term account progression before finishing up with the road ahead. All right, let's get right into our first focus area, setting the broader scene for week 25. Pulling the raw summary report straight from MetaTrader 5, we can confirm the gross profit was $16.20, cementing that 0.632% growth. But, transparency is absolutely key for us here. The drawdown figure for the week stands at 15.07%. We are certainly not here to minimize risk. That's a very tangible holding pressure that the account actually had to absorb in the live market to secure those gains. So what was driving that pressure? Let's unpack the macroeconomic environment that really defined the week's trading.
During week 25, the euro-dollar pair remained under some pretty heavy pressure. On one side of the scale, traders were actively evaluating shifting Federal Reserve policy expectations, and that was paired with ongoing, solid U.S. economic resilience. That combination created a very broad, undeniable strength in the U.S. dollar. And on the flip side, we saw persistent weakness in the euro. The crucial takeaway here is that this macroeconomic reality perfectly validates the strategy's short-side positioning. The system was simply aligning itself with that heavier macroeconomic tide.
Okay, so with that macro backdrop established, let's see how the automated system physically interacted with that high-pressure environment. The standout metric for us this week is simply the number 8. The system executed exactly 8 trades. And what's incredibly impressive from a purely statistical standpoint is that all 8 were closed profitably. There were absolutely 0 losing trades recorded during this reporting week.
Now, if you look closely at the MT5 ledger, you can see the rigorous discipline in the lot sizing. It's a uniform 0.02 lots per execution. And notice how the system captures these highly controlled profit increments of roughly 2 cents per trade. We're talking 2.00, 2.02, 2.08. This kind of controlled exposure is exactly how you build a reliable weekly gain without over-leveraging the account.
Mapping this onto the N15 market structure, you'll notice those blue arrows pointing up, those are our short entries. And the red arrows pointing down, those are our take profit exits. You can visually trace how perfectly these short executions aligned with that downward macro trend we just talked about. The system methodically layered in on those minor pullbacks and successfully exited as the overarching dollar strength pushed the pair lower.
Right, now let's transition to what is arguably the most critical phase of our briefing today, a transparent look at risk and floating equity pressure.
But before we dive into the charts, we really need to clearly define floating drawdown. This is simply a temporary equity reduction representing unrealized losses. It's vital to understand that floating losses are a completely natural byproduct of trend following and strategic positioning. Think of it as the operational reality of the market just breathing against your positions rather than some sort of systemic failure. You can actually see that market breathing visualized right here on the balance versus equity chart. That flat blue line at the top is our realized balance. The purple line represents our floating equity. Notice that pretty pronounced dip right before the 18th of June. We want to expose the reality of the market holding positions against the account. Look, maintaining a neutral tone is incredibly easy when everything's in the green, but you have to be just as clinical when you're analyzing these deep equity dips.
Tracking that equity dip directly over to our risk metrics, the dedicated drawdown chart traces that exact 15.07% peak. But honestly, the most important element on this chart is the subsequent recovery back to the 0% baseline. The system possessed the necessary margin to absorb the pressure, the macro trend reasserted itself, the trades cleared in profit, and the account stabilized perfectly. Okay, let's zoom out from the weekly turbulence for a moment and evaluate the overall health and trajectory toward that 10,000-cent objective. Putting these dashboards side by side really tells the whole story. Over on the left, we've got the micro view, our week 25 profit of 16.20 cents. But on the right, the macro view shows our lifetime total profit of 78.74 cents. This visually proves the entire thesis of how we run this account. Small, disciplined, 2-cent gains absolutely compound over time. Our balance has successfully marched from that starting line of 2,500 cents up to $2,578.74. And when we examine the full lifetime report, we can confirm that total growth now stands at 3.15%. But I really want to draw your attention to one very specific metric here, the historical maximum drawdown of 46.38%. This frames the week's events so perfectly. Yes, a 15.07% drawdown feels pretty heavy in the moment, but it's completely manageable when you compare it to the 46.38% historical turbulence that this account has already survived.
So, what does this all mean for our ongoing journey?
I want to leave you with a core philosophy of ours today. Trading isn't about overnight wealth, it's about survival, discipline, and managing reality. The long journey from 2,500 cents to 10,000 cents requires weathering the storms, not just avoiding them entirely. It requires embracing the raw data exactly as it is. Which leads us to a final, slightly provocative question for you to consider. Is your own risk management architecture actually built to survive the long, slow march to your ultimate target? We really challenge you to adopt this kind of documentary-style, ultra-realistic approach to your own trading progression. Eliminate the hype, respect the drawdown, and just focus on the math. Thank you so much for joining us for this explainer, and we will see you in the next update.